So we're continuing with objective 3.3 and adjusting the accounts. We talked about it conceptually. We discussed deferrals, accruals, and depreciation. So we're going to actually do some examples of adjusting journal entries. And the first thing you'll notice, especially after finishing chapter 2, is it just looks like the journal. And it is just the journal because it's a journal entry, just a different motivation. We're doing adjustments here. Okay. I would like to point out in class, we're going to do our adjusting journal entries on December 31 of each year. So our calendar year and our fiscal year are the same. That's just a simplifying assumption. In the real world, fiscal year ends can happen on any predetermined date. And adjustments happen on those predetermined dates. Okay, so we're truing up our accounts so that the reports capture the impact of all transactions, cash and non-cash. So on this first slide, we're going to do an example of deferral, which is a prepaid expense, rent. We look at the note. It tells us what the transaction is. We paid $24,000 for 12 months of rent. Now, this is not the adjusting entry. This is just the normal transaction or normal journal entry. But what we're going to do is record prepaid rent. And we paid cash for that. $24,000. So right now, this is an increase in an asset. So prepaid rent or any prepaid expense, so this is kind of weird. Prepaid expenses are assets. Once again, if you pay your insurance for the year and then you cancel it halfway through, you get half your premium back. So there is some logic to that. And we're crediting cash here, so we're decreasing the asset. Just trying to remind you of what you learned in chapter 2, so you can do this transaction analysis. Okay, we're going to record rent expense. Expenses are normal debits. So remember, in journal entries, debits first, rent expense. Okay, now we're going to just deal with the accounts. You might be thinking of what number we're going to put in there. When you're doing these journal entries, really any journal entry, but especially adjusting journal entries, first try to get the accounts correct and whether they're being increased or decreased, and then concern yourself with the actual dollar amount. You got to break down these journal entries. So this says rent expense. Rent expense is a debit. So we know that's our debit. Debits go first in the journal entry. So then the question is, what are we going to credit? If we had paid cash on the day it was actually like the end of the month or the end of the year, that might be a normal journal entry, but we're doing an adjusting journal entry based on the fact that we paid here at 7/1 on July 1st. So how many months of rent expense did we incur? You have July, August, September, October, November, December. 6 months out of 12 months in a year, and you had $24,000 for a year. That's $12,000. Okay, so you're reducing this asset account. You're using up an asset. So this journal entry is telling us we used up in this past year, or really last 6 months, but for the fiscal year we had used up $12,000 out of the $24,000 in rent that we paid. All right, let's look at the next one. It's another example of a deferral, and this one is supplies expense. And the first entry, again, it's a normal entry. It's just telling us we bought $2,000 of supplies, and it didn't tell us on account or not, so I'm going to say we bought it on cash. 2,000. On the first of the year, it was 3,000. The ending balance was 1,000. Okay. In the prepaid rent problem, what we did was we knew what we started with, and then we calculated how much we expensed. Oftentimes, you know what you start with and you know what you end with, but you don't know what you used up. So here with supplies, we started with 3,000. We bought 2,000, but the ending balance was 1,000. So the question is, we have 3 plus 2 is 5. We end up with 1. It has to be that we used up 4,000. Okay. And we're going to call that supplies expense. So this $4,000 is our expense. We use this T account as a way to back into that number. So we plug the 4,000. That's our plug number. And how did we get that? Somebody did an inventory account, which if you've ever done one of those, you know how painful those can be. But the reason we do it is to figure out expenses. Well, Zoom Cloud Meetings. That's not me. Somebody's logging into my account. Okay. So those were deferrals. We're going to move on to accruals, but let's break it up a little bit. We'll start this as the accruals in a second.